Welcome back, everyone. Kia orana, tātou katoa, tēnā koutou katoa. We're here obviously today to talk about our final decisions on bank capital. In doing that, I'm surrounded with some of the wise people who have dedicated 3 years of their life to this decision. I've got Toby Fines, Jeff Bask and Ian Wolford on stage with me, and there are some other team members who I want to congratulate for working through such a complex set of proposals. Today, as you're aware, we released our final decisions on our review of bank capital. Our decisions to raise bank capital requirements are about making the banking system safer for all New Zealanders. It's well known that bank crises cause significant economic harm that have long-lasting consequences. They also cause very distressful situations for both physical and mental health through financial ruin. These financial and wellbeing impacts are felt for generations. More capital held by banks reduces the likelihood of a bank failure. More capital held by banks also better enables them to weather economic downturns and better maintain good long-term customer outcomes. The level and type of bank capital we've decided on, we believe, hits the sweet spot for New Zealand's financial system. We are confident in our work that we are gaining both increased financial stability and increased economic output, and that is for the long term. The key decisions, which start to take effect from mid-July next year, 2020, include banks' total capital increasing from the minimum current of 10.5% now to 18% for the large banks and 16% for the remaining smaller banks. In dollar terms, that's an additional $20 billion of capital, and we've talked about $11 billion of that being common equity possible, and $9 billion of that coming through from redeemable preference shares. The average level of capital compared to the 18 and 16 at present currently held by banks is 14.1%. We've studied, we've listened and analysed the issues in a very open manner for over 3 years. Relative to our proposals announced to the industry 1 year ago, that was the fourth of our 4 consultations 1 year ago, our final decisions have included more flexibility for banks on the use of specific capital instruments, a more cost-effective mix of funding options for the banks, a smaller increase in capital for the smaller banks, which is about the smaller mess a smaller bank would make should it fail, and a longer transition period for all banks to reach this capital. On the transition period, we estimate in the documents there that banks can get to these new capital levels from retained earnings. We estimate as a rule of thumb that if they retained if their dividends were paid out only 30% of their profits rather than 70% of their profits over the next 7 years, they would reach these capital levels. Our decisions also deliver a more level capital regime for all banks, with the large 4 banks having to measure their risk exposures in a more conservative manner, more consistent with the standardised models that the smaller banks use to measure their risk assets, and more transparency in the whole capital reporting process, with the large banks reporting both their advanced and their standard models. As I've mentioned, these changes will be phased in over a 7-year period, and that is so that we can maintain the level of lending activity that is going on, the growth rates, and have a reasonable period of retained earnings should banks choose to only raise their capital through that process. I want to emphasise that nothing in today's decision alters the relative capital allocation or risk allocation for bank capital. It's about the level of bank capital. I do want to thank a broad group of people. These decisions are shaped by valuable public input It was unprecedented in terms of the input we have received through an unprecedented number of submissions and meetings and public focus groups. And I'm looking at a very pleased and tired team to be here at the end of travelling far and wide, making these meetings. Thank you very much. We've had international experts who have provided positive commentary and support for us, and we are confident we've got the calibration right for New Zealand. As we've mentioned, with the phasing in of these changes, we'll be monitoring the banks and we'll be reporting on progress over the next 7 years or so. In simple terms, it will be about a 1% increase per annum in the bank capital ratio through the transition, but the transition is outlined in the documents. That's it as far as a statement goes. We are open to questions.
Hi, Jenny Ruth from Business Desk. When did the banks know about these final decisions?
We briefed the banks this morning. We had a briefing at 8:30 a.m. With all the banks under a full non-disclosure requirements. So that was when they have found out.
Are they allowed to leave? Before
Yes,
noon?
they could leave, but they were under a non-disclosure.
So you just trusted them?
They were under a non-disclosure.
And was it all the banks? Smaller ones as well?
Yes. All banks were invited. Were all of the banks there? I can't
we had
recall.
a very high acceptance
so.
rate, but
Yes.
I think so. But they were certainly all invited.
And was
Both Wellington and Auckland, and people could call in.
was the Bankers Association invited too?
The NZBA were there as well.
And they were all allowed to leave before noon?
Yes. Some banks chose to have trading halts. That's their choice.
You've said that the four major banks make a higher return on equity than anywhere else in the world. How much has that got to do with the fact that they were allowed to use internal models?
Contribution of internal modelling to bank profitability?
I mean, I haven't done those numbers, but the one thing I would say is I think, one of the things the banks have told us is that we're relatively conservative on our internal model calibration. So I don't think the fact that there has been a difference between IRB banks and standardised banks explains in total. There's a myriad of reasons why, banks' cost structures and margins and various things. It's not solely about internal models.
Tim Hunter from NBR. I've got some questions in relation to the interest rate effects of these changes. I think you've estimated that it could add 20.5 basis points onto interest rates on average. In the draft proposals, there was some criticism of that the bank had underestimated the effect of that. Can you give an indication of how confident you are in those measures? What the variation might be within the outcomes, say, in different kinds of lending, and what will the Reserve Bank take any action of any kind if commercial banks choose to act differently according to their interest rate impositions?
So three nested questions there, and we've got three wise people and me. The first thing, the 20.5 basis points, we're very confident around our estimate. We originally went out with a range of, say, 20 to 40 basis points. Why has it ended up at the lower level? In part because the mix of capital that we have allowed the banks to have has changed. Redeemable preference shares are cheaper for a means of raising capital. It sits somewhere between a debt and a common equity instrument around the costs of raising capital, and given a big proportion of the increase that we're asking for banks could come from redeemable preference shares, that makes a material impact on that cost component. We also got a lot of feedback, and particularly from our international experts, that we had over-egged the cost for particular reasons, and that some of our modelling could be made better for particular reasoning, and so that adds to our confidence around the 20.5 basis points. But without doubt, there's a range of confidence around it. I'm not sure what the confidence interval is. I'll come across. The second part and third parts of your question really are at the heart of the competitive nature of the banking sector. Nothing that you see today changes the risk allocation weightings from what we're talking about, and it's going to be up to commercial decisions of the banks as to what and how they respond. And I would hope that there is sufficient competition that those who choose to respond in different ways will have other people come to see if they can make a difference, would be the activity. It should be highly transparent. Jeff or Toby to add?
No,
Yeah, I mean, just one thing to add, which is that we'll be monitoring the impact of these proposals very carefully over the 7 years of transition. We'll be releasing a report every year on how it's going. So if the interest rate impacts turn out to be different to what we expect, we'll reflect it in that.
I would just add one thing, and that is to be very clear that the 20 basis points that we're talking about is not a forecast of what interest rates would do. It reflects the economic fundamentals of the changes that we're making and how that translates into interest rates as distinct from interest rate movements. They move for all sorts of reasons. That's the kind of impact that we think our proposals
to give a scaler. And as we've seen through time, and as this audience has seen us, the Reserve Bank of New Zealand, speak many times, 20 basis points can be lost in the wash over a 7-year period based on other economic activities that go on. This would not be at the core of our concern when it comes to setting interest rates.
Thanks. Matt Zonmeyer from Kanga News. I was just wondering whether you had much consultation with domestic investors about raising that the potential $9 billion of redeemable AT1. It's obviously over 7 years, but still a fair whack for local capital markets to absorb. So was there much consultation there?
Yes, it was considerable, and it was received in a very positive manner. And we were given plenty of assurances that, for example, if it was all raised domestically, which I doubt would be the case, that quantum was well manageable.
Yeah, about 8%, I think, of the investment market. So absolutely, as the Governor has said, consultation with investment houses and others, we believe this is quite easily able to be absorbed, but we would expect some of it to be issued offshore as well.
James Ayres from the Australian Financial Review. Governor, I just wanted to ask about the motivation for the increases through the prism of your relationship with Australia and APRA specifically. There's a little bit of commentary in Sydney in recent months about part of the motivation being based on a concern that the Australian parent banks sort of would not be allowed to inject capital into New Zealand, into their subsidiaries, which would reduce your ability to deal with a financial crisis. And we saw some changes to the prudential standards in recent months reflecting that. I just wondered, is that at least in part of your thinking here?
I think stepping back and welcome to the Reserve Bank, and I think the highest possible level we have, I would say, one of the world's best relationships between a home and a host bank regulator, the RBNZ and APRA, and we work very closely together, and we share a lot of the intelligence that I'm surrounded by there. So there is an absolute no surprise basis that we go on. We both utterly respect each other's role, that one is the home regulator and one is the host regulator, and that we both have to have our own standalone capabilities. That is why the large banks, for example, are locally incorporated. They are subsidiaries, not branches. We need a legal, operational, financial, reputational, standalone capability if and when needed, and the ability to leverage that broader parent bank structure as it best matters. And so sitting back there, bank capital is just one of the many independent decisions that we need to make. between the home and the host regulator, and we try and do that in the most seamless manner possible. A home regulator has different issues relative to a host. The interesting one is that some of the banks we're now hosting are becoming, the branches here, the subsidiaries here are becoming so large that they're becoming a really interesting conundrum for the parent bank themselves. And so APRA and ourselves have been thinking hard about how we can make sure that both sides of the Tasman, are appropriately looked after. If one of these large banks should run into trouble, whether it be home or here, of course the regulators are going to have to be talking very closely together, but we both know what we can do within our own regimes if ever needed.
Bernard Hickey from Newsroom Pro. Governor, could you explain why New Zealand's banking system needs to have enough capital to have a crisis only once every 200 years rather than, let's say, once every 50 to 100 years, which is what the current capital suggests?
Yes, I think the simplest way is to say that we can have more of both, and isn't that a wonderful position to be in? We can have more expected output and more financial stability. So we're not trading these things off. So it's a sense that we can have more insurance and a lower probability of default without giving away future expected output, and in fact gaining it. Our cost and we then said, what's magic about 1 in 200? The answer is nothing. It's a nice simple round number for people to kind of get their heads around, but really it's come out of a calibration to say, where is our sweet spot? At what point are we, hand on heart, to the best of our calibrations and efforts, know that we are getting higher expected economic output over the long term and increased financial stability? And, we can shift from 13 to 16% or 14 to 18, whichever way we're talking about these things, and have a better world on both sides. So that's where it comes out around a 1 in 200. Could we go higher? Yes. Could we go lower? Yes. That is a sweet spot, and it's really articulated in the document. By the way, the 1 in 200, let's just think about that. Wouldn't you want to have far less probability of default if it didn't actually cost you anything in addition? And that's what we're getting, because bank defaults are bad.
The 0.43% benefit after the costs of the 20 basis points.
Net benefit, yep.
Why is that so large, really? Why would a bank collapse, particularly if one of the big four, be so expensive for our economy? Because it seems a lot over a long time.
I'm not convinced it seems a lot. I was probably sitting at the other side, not coming in with any prize, but what it means is about a net economic benefit of $1.25 billion per annum in dollar terms. And so that's the net economic benefit. Part of it is because the costs of bank failures are large and very long-lasting. By the way, it's quite a conservative estimate. All we've put in there is the dollar and cents type estimates, where we look through 4 different lenses trying to quadrangulate, how to calibrate this thing. None of it includes costs around the ongoing, I would say, physical, mental health challenges and social cohesion challenges that happen post-crises. We didn't even enter into that type of space. This spoke for itself alone. Any other?
I would just add that one of the external experts thought that when he assessed our cost benefit and some swings and roundabouts, but one thing that he was particularly drew out was the cost of crises can be much higher than estimated for the reasons that the governor's mentioning, and one of the reasons for that is that some of these things are very difficult to measure. They're very hidden, those sort of social impacts, hard to quantify. The reason why we wanted to put that into the cost benefit is because they're real and tangible, but difficult to measure. So we didn't even attempt to, but they're significant.
And I'll also just mention something that people often forget are the near misses. I always think about, I grew up in a forestry town. Deaths were very noticed, near misses were never counted. the amount of capital allows people, the owners of those banks, to be a lot more focused on good outcomes over the long period and much more focused on avoiding collapses, because they've got a lot more of their own skin in the game. And it's the near misses or the bailouts that can be very expensive but are never really picked up. So again, that's not captured in the essence of this, and not picked up in what the costs can be to society.
Giles Beckford, Radio New Zealand. Given the lapses and faults that have been discovered with the bank's internal modelling on their risk and the capital adequacy that they should be meeting in the past 3 years, we've had 3 banks, BNZ, ANZ and Westpac, all falling foul. Do you have confidence in the systems and the assessments and the judgments that they're able to make?
I would say our confidence is growing. But it will have to be something that has to be earned continuously. We were in a great position where you mentioned Westpac. We were able to put them back into the advanced model world, having gone and revisited how and what they were doing around the conduct culture, assurance tests of that, and they are now an exemplar of in the New Zealand banks around this modelling. All the other banks are, of course, now following suit. So it was something that arrived, it's something that got put in place, but not something that has been maintained anywhere well enough of what we would hope for them to continue to be advanced modelers. One good story here is that by putting a floor between the difference between the advanced and the standard models, it means we can be somewhat more relaxed that the more gratuitous use of these models for competitive reasons or mishap reasons will be minimised.
Does that mean that you'll have heightened vigilance and supervision?
Sorry.
We are absolutely looking at their compliance with our requirements and expecting much stronger assurance reviews by themselves that they are complying. You're right that at this point we are still finding some lapses, some areas where they haven't been tight enough, but we've lifted the bar and the standards, and we expect those to be adhered to in the future. So this is just part of overall really important that banks focus on strong assurance processes.
Matthew Brockett from Bloomberg. When you first came out with these proposals, the Australian banks basically threatened to curtail their operations in New Zealand. And I think at the time you described that as scaremongering. What gives you confidence that they won't, for example, restrict credit to the agricultural sector and hurt the economy that way?
The single biggest piece of confidence I have is that it's a competitive market. And I'll leave it there, yourselves.
There is, we know, adding to that some banks are looking positively at lending opportunities in those sectors. Some are adjusting their risk appetites, that's absolutely true. Some of them recognise that they've overlent and they've got their books a bit full. And there are some of those loans not performing as well as they had anticipated. So there's an adjustment period going on there. But as we've indicated, these proposals, they don't adjust the relative impact of capital. They just say you need more in total, and banks have to make their own commercial decisions. And we will be expecting
so one of the most
positive competition there.
One of the most annoying challenges that we had was that banks have been, rearranging their books continuously and in some cases reallocating loans to non-performing. This has been happening for 2 or 3 years. Why suddenly to use the cover of a proposal at that point a year ago was what most challenged us. I didn't think it was that wise as for long-term customer loyalty to point at something like this. I think people have realised that now. What they do will be what they do.
Hamish Rutherford from the New Zealand Herald. To what extent, compared to what you put out December last year, is this a back down?
Is it a back
down?
I think it's a sharper document in the sense that the costs are sharper. We've got a mix of capital where we get what we want at a slightly lower cost, i.e. the redeemable preference shares, but we've still got the total level of capital. So I think that is a fantastic side. So, and the transition period, we said 5 because that seemed like a long time. Our modelling work that landed us on 7 was as much about running simulations on how banks can continue their lending growth at this pace and still reach these capital levels with their own retained earnings and still paying dividends. So it was about saying, well, because we don't want banks to artificially use this as their excuse for doing something that they were going to do anyway.
And how much is the transition dependent on economic conditions? I mean, we've been in a long growth period, and at some point over the next 7 years, statistically, there'll be a recession. If New Zealand was to enter a prolonged recession, would you back off?
Too early to say. The idea is no. It was based on average profitability. We have you want to talk about the cyclical?
Yeah. So I think exactly as the Governor said, this is a long-term policy for long-term benefits. Having a quick transition isn't necessary to get there. What we want to do is to get to long-term resilience. We can adjust if we need to. One of the specific parts of the increase is the counter-cyclical capital buffer. It's scheduled to come on at the end of the last part of the transition and lifting capital levels. If we needed to, if we were in a difficult business cycle, we could delay that. It's there for when we have highly amplified financial cycle, and risks building. So if they weren't there, it would be plausible to postpone that as one of the adjustments. So, yeah, nothing's ruled out, but we want to lift capital to a higher level.
Stephen Wright from the Wall Street Journal. Should the small amount of tightening of credit conditions that you're forecasting is implicit in these changes, should that affect expectations of your easing phase at the moment?
In terms of our impact on monetary policy, I mean, we're on a hold phase. The answer is no, in the sense of the long transition period we've talked about and the small estimated impact on interest rates. So I would say it is happily lost in the wash of everything else we need to consider re monetary policy.
Yeah, I'd just add that, that is, every time we make a monetary policy decision, we look at the rates of credit growth, what the demand conditions and supply conditions are. We think that we can get through this transition with very little reduction in credit growth, given a longer transition in our modelling. But if things change, that would be one of the things we just look at in the data assessment as we assess monetary policy alongside all of the other developments that occur in international trade and domestic demand.
Tom Palastraka from Stuff. Kirk Hope from Business New Zealand has called for a further round of consultations on these decisions, because of the concerns he has about the impact on consumers and businesses. Is that something you can rule out? I mean, are these decisions?
We've ruled that out. We've done our work. These decisions are final.
Just add to that, there has to be a formal regulatory consultation as we put through the banking handbook as an exposure draft and the conditions of registration with the banks, but that's a formal regulatory part that will be done in the first half of next year.
Janae Tibshirani from interest.co.nz. I'm just wondering what impact the introduction of a deposit insurance scheme has had on this work. I mean, I appreciate the commentary that's been made around the fence at the top of the cliff versus the ambulance at the bottom, but could you detail a little bit further the impact of that new scheme?
Well, I suppose the first thing is you're talking about a deposit protection potential. around legislation that could come in the future, and that framework being put up over a long period of time. So we have to, just get a scalar on that. We're also talking about a proposed deposit protection scheme, which is at the small end of town in dollars, i.e. it's about people at least getting access to their working capital while a bank resolution is being undertaken. So it's to allow some working going on. It's not about the whole economic cost of a bank failure. So reducing the probability of default, which is what we're about, is still critical. You want to make sure that that is as low as possible without impacting on economic output. What you then have around the triage is an interesting but additional, it's not a substitute, it's a complement to the whole process.
Laura McDonald from Newshub. Just further to Tom's question about Business New Zealand, Kirkhope said that the likes of the rural sector had really no input when it came to your cost-benefit analysis. Are you confident that you have captured the full cost to the rural sector?
Extremely confident, and I'm not sure what the source of the information is. I'm sorry I haven't read, but I can point to some people in the audience here who have gone up and down the length of the country, wool sheds, asparagus rolls, and spoken very, very directly with key decision makers in the rural community, hosted by combinations of New Zealand Federated Farmers, and getting a lot of clarity out there around what this is about and what it isn't about. I do have to reiterate that nothing here relates to the risk allocation of capital. It's about the level of capital. And I'm probably a bit tired of having to say it. These are the banks who are making these decisions. It's not about the level of bank capital that we're doing here. And some banks are highly exposed to the rural sector, and they've been making decisions irrelevant of what we are doing. So, yes, very confident. So I just do want to finish on one thing, because our financial stability report talks a lot about this. Lending into the agricultural sector is still strongly positive. It's only a part of the dairy sector that is highly negative, and that is for a specific idiosyncratic set of reasons established by banks and borrowers, and that's the nub of it. So we can't set policy based on the few. This is based on the nation and the banking system as a whole.
Aaron Darman from News Talk ZB. Just on a really sort of base level, what does the everyday bank customer need to know, or what do you think they need to know out of this capital announcement?
That their banks will be safer through time. The banks will be able to absorb more downtimes than ever before, and that it's a more competitive banking system.
And what does it mean for lenders?
The same.
You sort of answered my question, but I just wonder why 7 years, why not, say, 10 years? It would have spread the costs even further.
It was interesting, actually. Well, some banks wanted to get there now. Some banks wanted to take slightly longer. There was no consensus whatsoever across the banks. Why do some banks want to get there? Because it'll level the playing field a bit quicker, or they might be closer to the capital level anyway. Other banks had different options of getting there, so it was a really mixed message. So that's why we did our own work, and we were looking at how we could be confident that all of the large banks were home and safe at the new higher capital level without having to change their growth in lending, and without having to go with a begging letter to the parent or diluting themselves through shareholding. Is that? Yeah. And 7 was the magic number out of the simulations we did, and I believe it's well explained in the documents.
Yeah, you cover that off. Yep.
Governor, why did you decide to change on the redeemable perpetual preference shares from saying they should be non-redeemable, slightly higher quality, to redeemable, because that's going to reduce the cost of that capital quite substantially for the banks.
Toby, do you want to?
I mean, a couple of reasons. First of all, we got some feedback from the market and from the banks themselves that non-redeemable preference shares will be more difficult to market, whereas redeemable ones are much more accepted, particularly in the US and also in New Zealand. So both the small banks and the large banks were encouraging us to go for redeemability. So that's the first answer. And secondly, our analysis showed that the costs will be significantly less, and that's part of the reason why the basis point costs of the changes are less than they were in the original proposals.
But isn't it lower quality capital that you've
been
pretty sceptical about in the past?
So it's slightly lower quality capital, but we're going to put some controls around it so that basically banks can't redeem these preference shares if they are under stress.
Just a final question on the counter-cyclical capital buffer and the opportunity to use it to push back against overheated market. Is there a risk here that this capital change might push the banks to focus a lot more, for example, on lending mortgages into the residential market, which they believe is less risky and therefore a better use of their precious capital, and they might take some of that lending out of dairy or wherever, that you could actually further inflate the housing market and then eventually have to use your counter-cyclical capital buffer to push back against it?
Well, again, banks will make their own competitive and credit allocation decisions in terms of the capital. We're confident that our risk weights on housing reflect the risk of that portfolio at a 35% risk weight. Higher LVR lending is more highly risk weighted. Different banks will take different competitive strategies, but the modelling we've done and the analysis we've done suggests that they can maintain credit growth across a number of sectors and spectrums, and we would expect them to continue to look at opportunities more broadly, and so we'll watch the economy as it unfolds.
Governor, would you use the counter-cyclical capital buffer now if you had it to try and push back against the housing market?
No.
Thanks, Matt Zonmai from Kanga News again. I was just had a quick question on disintermediation, which was mentioned briefly in the cost-benefit analysis. I think you talked briefly already about the possibility of more competition from banks, but what about more competition from the less regulated sort of non-bank sector, which at the moment is very relatively small in New Zealand compared to global standards, but how much capacity would there be for that to increase? And then on the flip side of that, how ready is the RBNZ to apply more regulation to that sector?
First and foremost, I would see it as a positive externality if our capital markets got broader in the offerings. New Zealand, part of the reason why we're looking so hard at the level of capital is because of the concentrated nature of the offerings in this country. When 4 banks have 85% of the intermediation, that is not a place that you feel that comfortable with, and we need a broader set of services that can provide a full range of financial delivery across the risk and return spectrum. So that would be good. What are we seeing at the moment? Not a lot of movement. We will be watching that space. We talked about that very clearly in our recent financial stability report, which I'd refer you to what we're looking at. The legislative review that we're going through, at the moment we are non-bank deposit takers regulator, so we're already in that position of regulating whoever may pop out, but we're also looking around a broader definition as well, which will be discussed.
It is something that we talked about and considered closely through the review process. It's something that one of the experts encouraged us to look at, again, positively in terms of competitive choices, but At the moment, it's a very small sector, as you note, and we think the risks are very low. That sector has pure common equity requirements upon it. We stand ready to look at it in due course if risks start to rise, but it's very small relative to the banking sector, as the Governor has said.
And for example, perhaps some parts of our rural sector would be feeling quite different if there was a broader range of options, longer term debt and or equity than what has been historically available. Thank you.
Just one more, Governor, if I might. You talk quite often about competition within the sector. One of the issues that the small banks had was that the proposals as drafted, in fact, may have widened the gap between them and the big banks. You've dropped the minimum level to 16% for the small banks. Does that level the playing field? Does that increase the competition?
This is a much more level playing field for the small banks as a positive externality, not a deliberate outcome. For a start, the 2% difference in Tier 1 capital reflects the difference in size of the banks and the chaos that they would cause if a large bank fell over relative to a small bank. The second one is the difference between standardised and advanced modelling. Putting that floor on the capital is, again, removing one ability to, I suppose, use your internal risk models as a competitive tool rather than a risk allocation tool. So that's a significant change. And then the ability to issue redeemable preference shares is a significant advantage that the small banks did not have. A lot of them were constrained to only raising common equity and so being able to grow their books.
Yeah, I think just to elaborate that point, that under the current rules, they were, their ability to actually market the convertible debt instruments was much more constrained. The large banks were more able to do that, typically to their parent. And so, the funding flexibility is increased for all banks.
Wonderful. I want to thank you all again. I know it's been a long day. Thank you for being responsible throughout. And I think I can say Merry Christmas to you all. Thank you very much.